Right now, a lot of people are suffering who were overloaded in bonds. And the problem is that's the go-to for most advisors when it comes to risk management. That's all they've got. But what we want to do is find safe, principal-protected strategies that are fixed, that are guaranteed never to lose money, that can still have the opportunity to market. You say, well, that doesn't exist, Colin. Well, I talk about it all the time. It does exist. Hi, folks. Colin Richards here. I'm president and founder of Lord & Richards. And once again, I am thrilled to be with you on this episode of the Lord & Richards Show. And in this particular segment, I'm going to dig into the real strategies that will help you deal with risk in your portfolio. I'm in a series talking about the top questions that we receive from pre-retirees and retirees about retirement. And one of the top questions is this: Colin, how much risk should I be taking in my portfolio? Right? And we've talked about first determining how much you can take, right? How much emotionally you can handle. And then secondly, we've talked through knowing scientifically what the ways are that are not working. Okay, the ways that aren't working, like dollar cost averaging, diversification, asset allocation, and so forth. But in this segment, I'm going to talk about what is working. What do the savviest, what do the wisest, what do the most successful investors do with their money to deal with risk? That is a great question. And I think rather than looking at failed strategies, things that were thrown against the wall, that have really let people down, such as the market crash of 2008, when people were left holding the bag for bad investment decisions on the part of their brokers. Instead, what we want is an advisor, a fiduciary, a comprehensive financial planner who is going to deal with risk from a much more scientific, broadly based strategy. And I'm going to give that strategy a name so that you can carry it with you today. All right. So if you want to put it on a bumper sticker, as my friend Keith Cunningham always says, I want you to have an investment barbell. Okay, now I'm all for lifting weights. You guys have segments that you can listen to on our YouTube channel and on our podcasts about the importance of health and retirement and muscle and protein, right? And so a barbell is something that adds weight to your body so you can build and maintain muscle. But this barbell is a science and finance barbell. You see, in his book, The Psychology of Money, I actually did a series on that book with Morgan Housel, who is the author, where I kind of did a review of it and went down through some of his key principles. And something that has really stuck with me since doing that series and reading that book and talking to Mr. Housel is that a barbell is a great approach for both typical and sophisticated investors to use when tackling risk in retirement or at any point in life. And here's the logic, the reasoning behind it, okay? Number one, if you'll visualize the two sides of a barbell, right? Like if you were a weightlifter, on the one side, we want to begin with establishing a safe, protected set of money that still has the opportunity to grow. So I'm not talking about cash under your mattress or usually even cash in the bank, although we're in unusual times now with high rates. We can get some pretty good rates on CD savings accounts and so forth. But generally speaking, your money in the bank isn't growing that much, so we don't put a lot of stock in that, no pun intended. However, what I'm talking about is having safe, principal-protected strategies that can grow at a moderate rate to secure your retirement income and your retirement future. And we've talked about that many times in different segments. On the other side of the barbell, what I want you to do is place a more aggressive strategy designed primarily around equities, which are stocks. It's ownership in companies. Particularly right now, I want you to emphasize U.S., right? It doesn't mean you can't diversify into the global markets, both developed and undeveloped markets. But what I really want you to do is put your faith in the good old USA for a number of reasons. Number one, long-term, you're going to come out way ahead than over-diversifying your portfolio across the globe. Number two, right now, the USA is positioned for great corporate earnings in the days ahead. When interest rates start going down, in the future, businesses are going to start investing at an even greater level, building, using debt in a wise way, capital in order to expand. And that's only going to mean money in your pocket if you've invested in U.S. industry. And so on one side of the barbell, a more aggressive approach. On the other side, a more conservative approach when it comes to risk. And what we don't want is we want that little handle in the middle, okay, the actual bar, to be really thin, to be really light. We don't want a lot of gobbledygook in the middle. What happens is people tend to over-muddy their portfolio because of misconceptions around diversification and asset allocation. And so we end up with a bunch of blah. And that blah might be bonds, right? Sometimes bonds look good, but those are really, I think, a market timing type of vehicle. Nothing wrong with bonds. Bonds can be valuable. Bonds can do things. But getting the timing right because of interest rate risk is a real issue. And right now, a lot of people are suffering who are overloaded in bonds. And the problem is that's the go-to for most advisors when it comes to risk management. That's all they've got. They've got cash, they got bonds. But what we want to do is find safe, principal-protected strategies that are fixed, that are guaranteed never to lose money, that can still have the opportunity to market. You say, well, that doesn't exist, Colin. Well, I talk about it all the time. It does exist. Okay, take the example of the Market Link CD, first invented in 1987 by Chase Manhattan, as it was called back then. The Market Link CD allowed you to keep your principal in the safe, protected CD, but link your returns to an external market index, potentially doubling, tripling, and more your low guaranteed interest rate. Those types of vehicles and many more are available to help you. And if you're looking at retirement right now, on that side of the barbell that is safe and market protected but can still grow, I want you to also consider looking at income strategies, because right now, companies that guarantee income, such as in annuities, are guaranteeing the highest income payouts for a generation. I've never seen these before in my career. And those payouts are guaranteed for your life. So even when interest rates start to go back down, that income that you establish that is so high, whether you need it now or in the future, you've locked in your rate of income for the rest of your life. So if you're going to wait, we've got great tools that allow you to continue to compound while you wait and then take out income at a greater rate than you ever could have. Or if you need income right now, incredible. So on one side of your barbell, I want safe, guaranteed, no market risk, growth with potential for guaranteed income. On the other side, I want to use a more aggressive approach so that you have a true, what we call at Lord & Richards, growing reserve that you're not even needing to live on. And this, folks, is the secret to feeling financially independent and wealthy in retirement, not having to live on all your money, not having to tie up all your money. Letting one side of your barbell take care of your needs, let the other side be a true reserve. Well, this is just the tip of the iceberg of risk management. We're going to continue this in future episodes. But in the meantime, I would love to have a conversation with you. My team and I would love to have a conversation with you about how you can become financially independent. It just starts with a call.